Hello and good afternoon to everyone that is currently tuning in live with us on another episode of Phillip Trading Podcast. I'm your host for today and my name is Trent. With me here today is my colleague Yongxuan, dealer and marketing executive from Phillip Capital. How are you today, Yongxuan?
Hi Trent, I'm doing great.
Okay, great to hear that. Welcome back. Okay, so for today's podcast, we'll be discussing on the topic Indices slide as Fed's future rate hike prediction horns. So to all audience out there who are currently trading the CME Micro Treasury futures or interested to trade, do not miss out this podcast. Once again, I would like the help of all our beloved audience today to share this video to all your friends. The more people that are watching this video, the more we are motivated to deliver greater content to all of you. So without further ado, let's jump into our topic for today. In this slide as Fed's future rate hike prediction horns. Okay, so following the Fed's rate hike by 75 basis points for the third straight time, interest rate had been rising sharply from 0.25% to 3.25% in about only 6 months. So with the stubbornly high inflation, we will discuss on the Fed's action on this situation. So Yongxuan, how did the Fed's economic projection change as compared to its previous forecasts in June?
Okay, so according to Fed officials, they actually want to adjust the policy with enough vigor to bring the inflation under control. But in the meantime, without overdoing their rate moves and also inflicting more pain on the economy than necessary. So the Fed policy takes time to trickle through the entire economy, while the rate increases have already begun to weigh on the housing market, and also the overall growth is beginning to slow down. And with the full impact of the central bank recent move could also take time to be felt. Business activity is actually slowing in response, but it is not falling off the cliff. For example, employers will continue to hire and wages will continue to be rise, and also inflation has remained the stubbornly quick.
Yes, the focus on the US economy has slightly changed since June. So for next question, based on your opinion, what could be the implications to the US economy from Fed's latest forecast?
So there are actually quite a number of implications that we could forecast. But first thing is that with the higher interest rate tempers the inflation by making it more expensive to borrow money, where this situation might discourage both the consumption and also the business expansions. That weighs on the wage growth and can even push the unemployment high, where firms cannot charge as much in a slowing economy and the inflation when the inflation cools down. So while the high interest rate, slower growth, and also softer the labor market conditions will also bring down the inflation, they will also bring some pain to the households and also those businesses. The Federal Reserve, they will not back down from this fight against the inflation, even though the aggressive will able moves to slow the economy will bring the pain to the households and also the business nationwide. So people like us, will be actually suffering from the high inflation, especially to those like vulnerable households. Then they also will ultimately suffer more for the coming months, where if the Fed flinches in its commitment to pulling the prices back down, which means that with a recession, with job losses and also higher credit costs or other unknown consequences, but they also will not let the inflation continue would be worse, and that might be delayed to lead more to the pain. So with the bank's new projections, including like a major economic growth and also the rising employment, which also indicates that the officials expect with this year-long campaign will also the rising of the interest rate will have its intended to the effect soon. But the Fed would keep it until it's done and give no indication that the bank is ready to ease up on its policies. With that, the narrow of the majority of the Fed officials expected to raise their rates by another 1.25 percentage points this year, which also could bring to the benchmark rate to around 4.4%. which could means that another supersize and three-quarter point move next meeting in November, followed by maybe another half point in December. So rates are expected to going to rise in 2023, where the first economic projection released since June saw rates climbing to 4.6% by the end of next year. So yeah, this will be what the Fed they have projected.
Okay, so let's see how the US economy will perform in the coming months. So how can traders capitalize on the Federal Reserve aggressive interest rate hike?
Investors and traders, they have times doubted whether the Fed would have really hurt the economy. They have also recently become like very concerned about the rate policy and also the economic outlook. So a grim set of projections could reassert them to how stern the central bank inflation fight has become. So they have a few major asset class that have been varied response in the face of higher rates. So, and of course, like commodities, they might spike higher, including oil, wheat, and also nickel. But many of those moves prove that it will be like a short term. So like prices of some commodities, they actually will be skyrocketed. And in many cases, those commodities have retraced some, if not all of those moves higher. So many commodities are well off on their recent highs, where a fewer supply constraints and also high interest rates work to take them down in a few notches. So other commodities also have spiked and then faded. More supply to constrain and also critical commodities such as oil and natural gas will remain high even if they are below their highest levels.
Yes, traders can certainly look for trading opportunities in the market that you have mentioned. So for our last question, what other news or upcoming events that traders should look out for in the coming weeks?
Okay, so there will be two upcoming events, which will be held on the end of the month. So for the US GDP for the quarter two, and also the China manufacturing PMI. So for the US GDP, where the Fed they actually projected with a growth of 0.2% for all this year and also around 1.2% for 2023. That will compare with 2021 GDP growth of 5.7% as US recovered robustly from the business lockdowns associated with the pandemic from a year ago. So preliminary estimates shows that GDP likely contracted by around 0.6% in the second quarter after 1.6% slowdown in the first quarter. So with the two straight quarters of the GDP growth, typically will places an economy in a recession. And the second event will be on China manufacturing PMI. So with the China's industrial production and also the retail sales grew more than expected in August, indicating that a recovery in certain facets of the economy might remain steady despite the headwinds from the new COVID-related curbs. So activity in China's main economic hubs is actually slowly recovering after they lift most of the COVID-linked restriction earlier this year. So for PMI readings for last month, it has actually showed that the manufacturing activity contracted for a second consecutive month in August. So with China's trade surplus also sank to a 3-month low during the month. So as also overseas, the local demand might remain weak. With the positive readings in August for China, the Chinese economy also has a very long road to recovery. So investors or traders are wary of more COVID outbreaks, as well as the risk of the economic growth from a struggling property market.
Okay, yes, investors should always look out for the pointers that you've mentioned. So thank you for your sharing, and I hope it will help the new investors out there. And to our audience who are interested to trade the CME Micro Treasury Yield Futures, you can now trade it in Phillip Nova. It's a smaller contract that only requires lower margin, which is also a great choice for retail investors to participate in the market. For more details, you can drop us a message on Facebook and our representative will get back to you. And now we have come to an end for today's podcast. If you have any question or any topics you want us to discuss next week, you can message us in the comment box below. Okay, thank you for listening to our podcast and happy trading for the week. Thank you for your time too, Yongxuan.
Bye-bye.
Bye-bye. Thanks.